Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, we'll bring you the latest on the government shutdown as the Senate makes progress in Washington. Plus, Disney results due out this week. We'll break down what to watch. And crypto recovering after a volatile week that sent Bitcoin flirting with a bear market. Is more pain ahead? All that and more coming up on Market Catalysts. Let's get a check on what's going on in stocks right now. We are seeing a rally here. It is really a sort of risk-on rally after the risk-off sell-off that we had last week. So the Dow is higher, but not hugely, right? It's only up about a third of 1%, about 150 points. But when you bring in the more tech-heavy S&P 500 and NASDAQ, you see bigger gains. We've got the S&P right now up 1.1%, the NASDAQ up about 2% or so. And then you've got things like the Russell 2000 also rallying today. Again, it's sort of risk on tenor. So how is this being felt in the NASDAQ specifically? You got a lot of green on the screen. Let's equal weight it just so you can get a look at the division a little bit better. Indeed, we have more buying than selling pressure going on in here today. And a lot of it is within the largest of large cap tech, which we saw selling off last week as more concerns were rising about what's going on in the AI trade. There was a back and forth about OpenAI, an executive making a comment about a government backstop, then other executives sort of walking it back. So all of that sort of fading away today. The government shutdown maybe ending is sort of the proximate reason. But, you know, really we're seeing sort of an action and reaction happening in the market to some extent here. If you look at the groups that are on the move, not surprisingly, XLK, which is tech, which was selling off the most last week, is up the most today. And just to put a fine point on that, take a look at the 5-day here, and you have the XLK down the most along with consumer discretionary. So that now reversing in today's session. And then if you look at crypto as well, I mentioned what was going on with Bitcoin. Bitcoin bouncing back a little bit today. You can see it's taking a little bit of a leg down right now, but still well down from the recent levels where it was. Here too, I'm going to take a look at a year-to-date chart of Bitcoin just to show what we have seen. So this was the sort of near-term top for Bitcoin. And that was, if I can draw on my chart here, that was back in early October. Then we saw a sell-off that got to about 19.9%, so pretty much in a bear market to some extent, or at least flirting with it before this little bit of a bounce back that we've been seeing. We're going to talk about that a little bit later in the show. But first, we got to talk about what's going on in Washington, because the current government shutdown has now lasted 41 days. It could be coming to an end very soon after the Senate advanced a bill that would fund the government through January of 2026. Several Democratic senators joined the Republicans for a 60-40 vote in favor of the bill. Let's bring in Henrietta Trey's Veda Partners Managing Partner and Director of Economic Policy to talk more about this. Henrietta, how close are we in your view right now, and what's the sort of timeline that we're looking at?
We are on the goal line at this point. We're almost done. It'll only take, let's call it 48 more hours, and we should be behind the America's longest government shutdown. So very exciting for all of us who want to travel for the holidays. It's almost over.
So Henrietta, we always talk about these shutdowns as the various pressure points that are being brought to bear, right? And in this case, there were a lot of pressure points, right? There were sort of temporary layoffs that the president was talked about making permanent. There were SNAP benefits and the battle back and forth about whether those were going to be paid out. And then, of course, last but not least, there's what's going on at America's airports, where we saw that dramatic curtailment in flights. In your view, was it cumulative? Was there one thing? I mean, what do you think finally got everybody to the table here?
What always was on my mind since October 1st when this started was, when's the next recess? And the next recess is right now, the Veterans Day recess, where they're supposed to be gone for 10 days starting on Friday of last week. So it's always helpful to keep the calendar in mind. I tell clients that all the time, but you're exactly right. It's this culmination of all these events. You can go back to the No Kings rally with 7 million people across the country. You can go to last Tuesday's election, which was, a very big momentum event for the Democratic Party. You can go to the discussion of SNAP, which I think was really instrumental, not to keep harping on and picking on the president here, but his approval rating throughout the course of this shutdown was cut in half. It or doubled rather. It got 7 points worse than it was when it started. And that was largely driven by the food stamp discussion, knowing that the president was actively suing to make sure that SNAP could not go out. The furloughs of 700,000 employees across the country, disproportionately in the state of Virginia, where, of course, there was a very important governor's race and the Republicans lost by double digits. So net, it took time. It required the calendar. It required members wanting to be on recess. The TSA and FAA stuff really helped. We're finally there, though.
Speaking of the calendar, the House is not in session. So how does that all going to work? Will Speaker Johnson finally have to call them back?
Yeah, so Speaker Johnson has effectively let them know the all call. You need to start getting back, whether you can drive or you need to take flights, whatever it may be. You've been gone since mid-September. So it's time to come back. We're going to take these votes quickly. I wouldn't be surprised if the president has to put the squeeze on some of the Republican members to get them to vote for this package. And I understand that there will be a handful of moderate Democrats who will also support it. So there should be enough breathing room for Speaker Johnson to be able to get this through. What's going to happen is the Senate is going to leave after they vote on this package tonight. And then that's really going to force the House members to accept what they've got. Otherwise, we'll be shut down into Thanksgiving. Nobody wants that.
No one does. You mentioned President Trump putting the squeeze on. What role has he played thus far? You also mentioned sort of his favorability ratings, but he seems to have taken a little bit of a backseat, or he's sat back during this process. Is that going to change as we go forward?
I doubt it, only if the Republicans require it. But because the White House has blessed this deal, he shouldn't have to do too much. And quite frankly, he has been absent for the bulk of this shutdown, getting involved only at the end to call for the elimination of the filibuster, which is a complete non-starter on the Senate side. So I don't expect the president's going to have to twist arms too much, but you can never discount the willingness of just a couple of members in the House to make waves when they can. They're going to be in front of media cameras. There's always somebody who tries to be a holdout. So don't be surprised if we get a little bit of a roller coaster here. But the president and the White House will put the pressure on Republicans to move this bill forward, get it 218 votes, reopen the government, and get on with business.
Henrietta, what happened to the ACA subsidies, right? Because the Democrats had said this is what this is about. This is what they staked it on, that they wanted the extension of those ACA subsidies. This bill that's before the Senate doesn't have those ACA subsidies. So how did the Democrats go back home and sort of present this, the ones who have decided to vote for it?
This package wasn't, I don't think, about convincing Democrats to support Democrats. They obviously wanted to see members put up a fight. But this is kind of what happens when you play chicken with somebody who has nothing to lose. The Democratic Party has been in an abysmal state of approval for the better part of a year now. And it's mostly because Democrats dislike Democrats. So Schumer had to have this fight. Leader Jeffries had to have this fight. They've seen their own personal standing improve throughout the duration of the fight within the conference. But what really has occurred is not an extension of the ACA subsidies, but a discussion about it. And so now if you are disproportionately in a state that voted for Trump, you know that if you're 60 years or older, your cost of healthcare just increased by $1,919 going into next year. And that's because you had a consistent 41-day shutdown premised on the idea of these ACA subsidies. So the whole purpose was to just put this in the spotlight. And now it wasn't just the month of October that we were talking about it, but we're going to have a vote on it at some point in December. And then there's going to be another threatened government shutdown in January. So it's going to stay in the spotlight. And historically, that works as a winning message for Democrats, particularly going into midterm election cycles. And the comp is 2018, when, of course, Speaker Pelosi picked up 41 seats on the House side running on very similar topics. So I think that was the purpose, and that's the takeaway.
What does happen in January, Henrietta?
Well, we have a potential risk of shutting it down all over again going into January 30th. So fingers crossed we don't get there.
And then finally, I wanted to ask you about President Trump's comment on social media over the weekend that everybody's going to get $2,000 because of the tariffs. And it seems like then there was some commentary from Treasury Secretary Besson who said, oh, he just means the tax savings you got from the one big beautiful bill. He doesn't mean an actual check. I mean, what are we to make of that comment?
I don't think it's any secret that the president really liked the rebate checks that went out during his first term. And to put this into some context for you, back then at the height of COVID, when we passed a $1,500 tax rebate and $500 for children, that cost $292 billion. If you want to do $2,000 for everybody now, it's going to cost upwards of $450 billion. And it's a rebate check because we're all paying the tariffs. And just for reference, the tariffs had brought in $89 billion under the IEEPA statute this year. So neither the tariffs will pay for this, nor will anything else unless you want to raise taxes elsewhere. So it's a non-starter of an idea. I think we should expect the president to include it in his fiscal year 26 budget, which will come in February, but we should not be counting on $2,000 checks from the president next year.
Oh, man. Oh, well. Henrietta, thank you. Appreciate it.
Thanks for having me.
Let's turn now to the impact on airlines that we have seen from the government shutdown, which led the Federal Aviation Administration to reduce air traffic by 10% at 40 airports across the country. Transportation Secretary Sean Duffy now says commercial air travel in the U.S. will be reduced to a trickle ahead of Thanksgiving. Joining us for more, George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Industry Analyst. George, it's good to see you. Seems like we're coming to the end of this thing, hopefully. How long, then, is it going to take for schedules to return to normal?
I mean, I think you could do it in a couple of days. I mean, right now there hasn't been a lot of cuts as it is, right? I think we're still well below 10% kind of cuts to operations. So there's not much more to restore. I think the airlines are just sort of pick up their old schedules. I think the challenge is getting the getting the controllers paid and getting them back on the job right away.
When all is said and done, how much do you think this is going to cost the airlines?
Yeah, I mean, right now, we're not too excited about it, right? I think you see that too in some of the stock prices today. Look, I think if you're an airline right now and you're being asked to cut some of your operations, you're going to go pick some of the least profitable operations. You're going to pick the smaller aircraft. And they're not even at 10%. Again, what I've heard Friday was sort of 4-ish, 5-ish%. So you cut 4 or 5% of your worst performing flights. I think you might even see a slight margin increase, and maybe on an absolute level, profits are a little bit lower, cash flows a little lower. So we're not excited about it yet. Now, look, if this drags on, I think the controllers are at this point where they've missed enough paychecks, where some of them will be not willing to pick up additional shifts, and that creates problems in the air traffic control system. I don't think they're going to shirk their duties and not show up for work entirely, but again, sort of the extra shifts, I think helps keep things going in the U.S. airspace. And I think then you're going to start to have more effect on operations. And as you roll into Thanksgiving, which is a sort of peak travel, it's a big peak crunch travel time, then I start to get concerned about profits for 4Q, because those are sort of usually high ticket prices, a lot of demand, and that's what's going to help build a lot of the airline profitability for 4Q.
George, to dig into Thanksgiving a little bit, I mean, had we seen people holding back or even canceling their Thanksgiving flights because of anticipated disruptions from all of this?
So typically what we see is that leisure travelers are booking sort of 50-ish, 55, 56 days before travel. And so I would expect that the majority of Thanksgiving is actually already purchased. It gets in the plus 60 days as you get into December. So as people think about the year-end holidays. So even those tickets are probably largely purchased. The challenge, usually business comes in short order and, 2 weeks out buys a ticket for travel. Business travelers really don't, sort of go on trips here, after sort of the first week in November until after Thanksgiving. Then there's a small window that opens, and then you get into the year-end holidays. So I think the tickets are already purchased. I don't think people can cancel and get a full refund. They might be able to get credit. So I don't see demand dropping off. So I think it's sort of already booked. The question is, will it fly?
And I'm also curious, just generally, how Thanksgiving is going to look this year. You know, it's always kind of messy, right? Just holiday times at U.S. airports tend to be. But what are the volumes this year versus what we've seen in recent years, and are the airlines up to it?
So I would expect volumes to be up, 4 or 5% over last year, sort of in line with some of the, supply additions we've seen from the U.S. carriers. Again, if the U.S. government stays closed over that time period, I'm very concerned that it would be a mess because Thanksgiving is a real crunch, right? Everybody sort of gets away for a weekend. You want to go home and see grandma or mom. You don't want to spend a lot of, a week's worth of vacation getting there. So it's a real tight crunch. And if the government stays closed, it could be a mess. A lot of airlines will owe credits maybe for people that can't fly, but it could be a real mess. Yeah.
And George, we were just talking to Henriette about how, this agreement to reopen the government looks like it's going to just push it off until January. Is there anything sort of defensively that the airlines can do to, prepare for this potentially happening again, or they're sort of at the mercy of the air traffic controllers?
I mean, I think they're a bit at the mercy. I mean, this is coming again in sort of the airlines' non-peak seasons, 4Q and 1Q. You get it past the holidays and the airlines can make their money on the holiday season. I think the next big concern the airlines are going to have is sort of getting into March, getting into spring break, maybe late February. So for the airlines, if you want a fight going on that's going to affect air traffic control, and again, maybe TSA, yeah, January is probably an okay time to have it. You don't really want it, but January is probably an okay time to have it.
All right, we'll mark our calendars, and that's a good reminder to me to book my spring break travel. George Ferguson, Good to see you. Thanks for being here.
You too.
Coming up, what to watch as Disney reports its fourth quarter earnings. Stay tuned, you're watching Market Catalysts. Disney is set to report fourth quarter earnings. Investors are closely watching the company's streaming and parks businesses, of course. Joining me now, Jason Bazinet, Citi Media and Entertainment Senior Analyst. Jason, it's good to see you. So the sales growth at Disney for the quarter it's about to report expected to be kind of tepid, right? I think 1% is the consensus. But you and the company are looking for re-acceleration next year. So is this quarter sort of just a placeholder for Disney in some ways?
Well, I think one of the main, potential growth vectors is going to be some of the pricing action that they're taking in the parks that should, benefit next year. And you also have ESPN Unlimited, which didn't launch until August 21st. So that should be the other potential accelerant as we move into next year. It won't impact this quarter that much.
So we're looking for some of those early signals as to what's going to happen on next year. Let's dig into the pricing element for just a moment here, because given the sort of economic backdrop, is that pricing going to be sort of a delicate dance for the company, a double-edged sword potentially, that yes, it would bring more revenue through the door, but what's the risk that it's going to keep people away from the parks?
Well, Disney went through a pretty extraordinary period prior to COVID where they were raising prices and the admissions were still going up. That's when they were benefiting from a lot of the CapEx investments that they made in the parks. In the era that we're in now, it is a little bit more of a balancing act where you could begin to see some trade-offs between price and volume. When we've run the elasticity analysis on it, I think we're probably 3-4 years away before we sort of get to a point where a price increase would result in less revenue. So I'm not saying it won't result in less admissions, but price hikes will result in more revenue. We're still at that part of the elasticity curve.
And then on the streaming side of the business, I know you're going to be watching closely any indications as to the effect of how many people canceled some of their subscriptions as a result of Jimmy Kimmel being taken off the air or suspended briefly. What are you going to be looking for exactly, and what kind of commentary are you looking for?
Yeah, I don't even know if they'll ultimately address it. I mean, I'm sure they would if the show stayed canceled. It will probably result in a small blip. I think we took our numbers down a few million based on the Kimmel sort of controversy. I think the far more interesting thing, because it's potentially secular in nature, is the launch of ESPN Unlimited, which is really the reason it's so seminal is this is the first time, starting in August, where if you're a sports fan, you can get essentially all of the sports from the Big Four leagues on a DTC app. Not necessarily from Disney, but if you add up, all of the DTC apps, consumers don't really need a pay TV subscription now for sports. That's brand new.
And so what effect do you think that'll have on Disney and I guess ESPN? And how big of a phenomenon do you think ESPN and driver and contributor do you think ESPN Unlimited is going to be for them?
I think in the quarter small, but I think it could be a very big driver going forward. When we've cranked through just to give your viewers some context, virtually all of the cord cutting that we've seen so far has been from non-sports households. So if you have a pay TV subscription today, the odds are very likely that you care about sports. What the math you have to run through is if someone cuts the cord and Disney loses the affiliate fees, how does that compare to the upside they get from getting the subscription revenue from DTC Unlimited? When we crank through all of that math, I think there's at least $10 of upside to Disney's share price as this transition away from linear TV towards the app plays out. And investors, interestingly, are totally ignoring this. It's one of the great inefficiencies. And I think I know why they're ignoring it. The companies themselves are talking this down. And so the buy side institutional investors don't think it's a big deal. Why are they talking it down? Because I think they're afraid of upsetting the TV station affiliates that they have. So think of a broadcaster that's partnered with ABC. They're really sort of sticking a finger in the eye of their own affiliates. And so I think they're pushing on this pretty aggressively. I mean, as we sit here today, what's happening? YouTube TV and Disney are in a dispute. I suspect the reason is Disney is trying to get those YouTube TV customers to terminate YouTube TV and migrate over to ESPN Plus, right? There's no alternative.
I was gonna ask you about that, Jason. Do you think that's gonna work? And what does that imply then about how long that blackout might last?
I think normally in my seat, we've seen these blackouts and they usually get resolved in a day or two. I think we're in a new era now. I think they may not reach a resolution. It's entirely possible. And the reason is very simple. Disney has an alternative, right?
Wow,
I mean, they're going to go from wholesale economics through YouTube to retail economics through ESPN Unlimited.
That is a huge, huge change, right? As you mentioned, do you think that is going to be then it sounds like you think that that's going to be a successful bet for Disney to make? Absolutely.
I think that the stocks that will get hurt on this transition are the a pure play TV broadcaster. That's where you have to be nervous, because what this is essentially doing, if you think about those retransmission fees that the TV stations get from a pay TV operator, it's really because of sports. And so, what we're doing is we're just putting the consumer directly in touch with the sports app and not going through this Rube Goldberg machine of getting a pay TV subscription that then pays the TV station operator to then pay some of that money back to the network like ABC. So it's better for consumers, it's better for Disney, just worse for pure play broadcasters.
Jason, finally, I guess we can't have a conversation about Disney without having a Succession conversation also.
Sure.
I think that we're set to get the Disney Succession announcement probably early next year, unless you think it could be coming early. And there's some press reports recently that Josh D'Amaro maybe is the front runner. What do you think?
Yeah, I would say that's probably a pretty good bet. Somewhat interestingly, there seems to be less anxiety about this transition than there were in times past. And I think some of that, somewhat ironically, is because the street is not as enamored with Mr. Iger's performance, given how sort of mediocre the stock has been. And so I think there's a bit less drama this go around. What I would say is that what I would like to see the new CEO do, whoever it may be, is really double down on streaming. A lot of these streaming apps have been held to sort of curtail their content spending to generate some modicum of EBIT margins in that business, and that's really crimped their growth. What I'd really like to see is somebody just rip off the Band-Aid and say, look, we're not here to maximize EBIT in our streaming business. We're here to win, and that's going to require more investment. And sort of tell the street, we're going to go back to break-even economics on DTC, but really emerge as a real potential competitor to Netflix.
Interesting. Jason, great to catch up with you as always. Thank you.
Absolutely. Thanks for the time.
And be sure to tune in to Yahoo Finance Invest. It's this Thursday, November 13th. We've got a special full day of live global coverage of the key themes driving the market with the top people in corporate America you'll want to hear from. And that includes Ted Leonsis, Monumental Sports and Entertainment CEO. Will be touching on some of the very same themes we were just discussing with Jason. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Palma. We're live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're taking a closer look at shares of NVIDIA, Affirm, and Sunrun this morning. NVIDIA shares moving higher this morning after Citi raises price target on the stock. That raise is to $220, and that's up from $210. As you can see on your screen, the stock now around $196. The firm wrote a note to clients that it believes aggregate hyperscaler cloud revenues are inflecting in 2025 and are expected to accelerate in 2026, driven by enterprise AI adoption. We'll keep a lookout for that. Next up, we're watching shares of Affirm. Mizzou analyst Dan Dolev raised its price target on the stock to $114, up from $108, after the company beat Wall Street's expectations across all key metrics. Heading into the report, there was investor worry about emerging consumer credit concerns and third-party data, but that stock clearly moving higher, up about 4.5% this morning. And last up, we're taking a look at Sunrun. The Guggenheim upgraded its rating on the solar energy company to buy from neutral. The analyst said its recent results underscore how effectively the company is managing the business in a challenged industry. And now with the stock down 16% following the report, it's provided a, quote, attractive entry point for investors. There are 16 buy ratings, 8 holds, and 1 sell on the street. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls during today's trading session.
Now time for some of today's trending tickers. We're watching Plug Power, Eli Lilly, and Tyson. First up is Plug Power. The developer of hydrogen energy systems suspended its efforts to complete a $1.6 billion loan guarantee from the U.S. Energy Department. That might sound bad, but investors had been bidding up the stock. Now it's down again. It's been all over the place. But Plug said it is pursuing other measures that will generate $275 million in liquidity improvements. Those will come, it says, through a combination of asset monetization, release of restricted cash, and reduced maintenance expenses. The company has also signed a non-binding letter of intent to monetize electricity rights in New York and another location, and it'll collaborate with a data center developer. But this loan had been a real outstanding question for the company. Next up is Eli Lilly. It is inking a $100 million plus deal with In Silico Medicine in hopes of using AI to discover new drugs. Shares touched a record high amid that announcement. The company will combine In Silico's Pharma.ai platform with its own expertise to try to jointly identify and advance novel therapies. And then there's Tyson. Those shares are rising after the company topped fourth quarter adjusted earnings per share estimates. It does expect results for next year, though, to be little changed as its beef segment continues to lose money. Higher demand for chicken, which is Tyson's second largest source of revenue, helped offset beef losses. The company also forecasts total sales growth of 2 to 4% next year. That would imply revenue of about $56 billion, which would be above what analysts are anticipating. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, how to play the software sector. That's next on Market Catalysts.
Investors want to know who's actually cashing in here, from enterprise adoption and cloud competition to M&A that could reshape the landscape. We're navigating how to play the software space with the Yahoo Finance playbook. And joining me now, we have Jackson Ader, Managing Director and Equity Research Analyst at KeyBank Capital Markets. Jackson, great to see you. Let's start maybe there with that AI theme, Jackson. You know, obviously we see consumers experimenting and adopting, Jackson. I'm curious, what are you seeing in the enterprise, though? You know, a space you know very well. What are the trends?
Yeah, I think there are two clear trends in the enterprise. One is that some enterprise software players are quickly becoming some AI hardware players, right? So Microsoft with their Azure business and Oracle with their Oracle Cloud Infrastructure business are into the AI infrastructure game. And then the rest of the enterprise, the companies like Salesforce and either in Adobe or ServiceNow, they are trying to sell enterprise AI agents or enterprise AI software and embed them into their current products to then go and sell to customers.
How do you, Jackson, I'm just curious, is it tough as a financial analyst to try and distinguish, okay, this is genuine AI monetization versus marketing fluff?
Yes, it is. Because we are subject to what the companies want to disclose and what they, want to tell us. But, I think that it all comes out in the numbers. If a company is telling you that their AI products are on fire and yet their revenue growth continues to decline or decelerate, you can make your own assumptions, I think, about that. And on the flip side, if you start to see some leading indicators like net retention rate, or I really like to look at net revenue dollars added in a quarter or in a year, that kind of tells you if the net revenue dollars added are also growing, then that kind of tells you some things are moving in a positive direction. And that might be due to artificial intelligence actually being monetized at some of these software companies.
So who would you say, Jackson, just based on your coverage universe, the names you know so well, who would you say, okay, these are some names that are leading the pack when it comes to AI monetization?
I think one to look at that is interesting so far is probably ServiceNow, because ServiceNow has an actual SKU, an actual product line called their Pro Plus or their Now Assist that is still seat-based, but has AI functionality built right into it. But they get to run a very similar playbook that they have before, which is go to their install base and sell this new AI product SKU that is not necessarily, dependent on whether people use the AI a bunch or whether the agents are going off and creating a ton of value and getting this hybrid revenue model. They're still mostly seat-based, but they're talking about getting to $500 million in ARR from that AI SKU by the end of this year, and then up to $1 billion by the time we get to the end of 2026.
I want to switch and talk about the great cloud wars too, Jackson. When you would think about that war, you used to think, okay, it's Amazon, it's Alphabet, it's Microsoft. Is Oracle now officially that fourth player? And maybe, Jackson, at some point could even supplant one of those three?
Yeah, I think so. I think OCI, at least in terms of the call it the US based cloud companies, is absolutely the fourth horseman. I mean, you don't sign $300 billion of contracts for your infrastructure and not be part of that exclusive club. So I absolutely view them as kind of a fourth hyperscaler here. But it is interesting. Some of the other hyperscalers, whether it's AWS or GCP or Microsoft Azure, they are really seeing really strong adoption from the more traditional moving workloads on a CPU basis or moving workloads from someone else's basement to the hyperscaler's basement. Oracle really doesn't have much of that type of a business. They are really moving forward with the GPU-based hyperscaler model. And so that's why they get a seat at the table today that they didn't necessarily maybe 5 and 10 years ago.
The past week, Jackson, it's been a bit bumpy for Oracle. It is down about 10%. Is that just Oracle getting caught up in this kind of broader, AI valuation worries or something more there?
I think so, because they are, Oracle Cloud for a little while here during the GPU race was viewed almost as the spillover cloud. If you couldn't get capacity from maybe Azure, you would try and see if you could get it from Oracle or from one of the neo clouds. And so if you are getting the incremental dollars or incremental spend in the GPU clouds, then if there is any kind of risk that spend might be getting ahead of itself, it's logical, I think, for investors to say, well, this company is a little more levered to that spend than others. And so if there are going to be worries about the spend, it's going to be Oracle that'll feel the brunt of that. The other thing is we, at least, again, we cover both Microsoft and Oracle. In our estimation, we believe Microsoft is going to have enough cash flow and cash flow from operations to cover what they're going to need for their CapEx for the next few years, whereas Oracle is going to have to dip into those. We have them at negative free cash flow for the next few years, and they're going to have to finance a lot of this build out.
After a banner year for crypto with tailwinds from Washington and Wall Street, selling pressure has recently returned with a vengeance. Bitcoin recently flirted with a bear market. Let's talk more about it with Andy Baer, CoinDesk Indices Managing Director. He's here with me at the desk. Andy,
yes, no relation to the market, Andy Baer.
No. Yes, I guess Bitcoin, you never know. I mean, but so what kind of cycle are we in now then? Right. How do we think about that?
After the sort of late August peaks, that kind of represented the maximum positive momentum and vibe coming from the regulatory improvements, the legislative improvements. It was important, it was critical, I think, that Ether participated really strongly and hit its all-time high, which was breaking a 4-year-old record. Bitcoin did too, CoinDesk 20 did too. Like, it was a really broad, exciting rally that was based on the hope for growth and a continued good Bitcoin story. And since then, a lot of liquidity pulled out of the market, sentiment soured a little bit. Alts really took it on the chin. And then the government shutdown kind of really brought on this malaise that turned this kind of tenderness of the market into a vulnerability. Then the October 10th, episode happened, which was not a great look for the market. It showed some cracks in the armor for how things like perpetuals are dealt with offshore. And that was just a reminder, you really have to be careful what kind of instruments are out there trading in that kind of size. So it all kind of culminated, and at the end of last week, I noted that 3 of the big permabulls in Bitcoin adjusted down their price targets. Smart people, and we knew. I felt like, well, that's got to be pretty close to the bottom. And then last night we kind of got this news, which might come, to show that segment of time has resolved.
The stuff that you talked about from October 10th, though, that hasn't gone away, right? In other words, part of it is the offshore stuff you were talking about. Part of it has to do with also margin, buying on margin in the market. Has that been did that sort of wash that out of the market? I mean, there's got to still be some.
No, I think, look, you need liquidity and you need leverage in the system. 3/4 of all crypto trading. Crypto can trade 3 times its whole market cap in a month. In August, that great month, we had nearly $10 trillion of trading. 3/4 of it was in derivatives, which implies that there was some leverage there. So just like any other market, interest rates or equities, you need leverage in the system. One of the interesting characteristics of the perpetuals futures market offshore in crypto is that if you get liquidated, there's no stigma attached to it in some of the outlets, right? You post collateral. If you get liquidated, you come back the next day and try again. It's almost more like an option than it is a futures contract. Whereas, here, when you're working with an FCM on a regulated futures contract and you don't meet a margin call, we've all seen trading places. It doesn't end well, right? So part of that kind of impunity of liquidation is just a characteristic of the crypto markets. The centralization of liquidity on each exchange rather than having it work through clearing houses and things like that show kind of an early market that's still kind of, owner operated. Those things will evolve over time. But there was a little bit of a hangover from that, and, did anybody get damaged? Who's my counterparty going to be? Let's, wait until the dust clears and see what happens. And then we were in this liquidity environment that was so tight that the Fed had to come in and, do some unscheduled repo activity to help restore the bank's balance sheets. So it was all in all a liquidity evacuating time during October and November, and hopefully now with the government back open, things can stabilize. Fiscal flows can resume, and we can sort of take a deep breath, look at what happened, but move forward.
One of the other phenomenon we've been watching closely is that of crypto treasury companies putting various types of crypto on their balance sheet. And not surprisingly, when the prices go down, it's not great for those companies. So does that mean, if you think Bitcoin and crypto generally has bottomed, does that mean those companies have too?
I think that digital asset treasuries have a unique opportunity to add value for investors in that if you look at asset management wrapped products, you have a limited number of tools in the toolbox, right? You can do things, you can write options, you can stake your tokens, you find ways to get yield, you can manage portfolios actively. There's a ton of things you can do. But you can't do all the things that a corporate treasurer can do.
Like what?
Like lend, like actually have lending, like have bilateral agreements, like have term agreements that wouldn't be allowed in a vehicle that needs daily liquidity, right, which ETFs do. So it kind of enters into this new space where treasurers can be clever. When strategy, MicroStrategy/strategy issued converts and then issued preferred shares as a way of kind of making their balance sheet take advantage of Bitcoin's volatility properties, that's pretty interesting. So I think there's a way to bring new types of financial engineering skill that can add value. Now, that may cause people to want to rush into certain DATs, certain DATs, and that can push prices above, their sort of book value. And when liquidity comes out, things will fall below the book value, known as MNAV in the new parlance. But I think that over time, that kind of structure will mature, and you'll see real skill, you'll see fundamentals attached to certain DATs. Not just kind of religious following of them.
Right.
And I think it'll evolve over time. And the ones that trade below NAV will trade below NAV like closed-end funds do, and that's a market. So interestingly, a lot of crypto is being held by them, as it is by ETFs and governments and other things. So that those digital assets tend to be parked. But I think it's a space that is not going to go away, and I look forward to seeing what comes next.
Yeah, should be interesting. Thanks, Andy. Good to see you. And be sure to tune into Yahoo Finance Invest this Thursday, November 13th. Speaking of digital asset treasuries, we'll be speaking with Michael Saylor, Strategy Executive Chairman, among other top voices in corporate America who you'll want to hear from. All of this starts at 8 a.m. Eastern on Thursday. Join us then. In the meantime, that's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.